So my name is Mitch Michigan, and I'm a partner at Blockchain Coinvestors. Thank you very much for your time and for joining us today. Blockchain Coinvestors was founded on the thesis that all of the world's assets, monies, and commodities will digitalize. Just as the internet digitalized communications and content, blockchain technology, we believe, enables the digitalization of commerce and transactions. And since commerce and transactions are larger than communication, we think that this is going to be one of, if not the largest, value creation events ever. And today we're going to interrogate that thesis, actually. We're going to actually look at what are the actual commercialization use cases of blockchain? What really are the use cases? Are there any products today that are commercially viable? Before we get into that, I do have to show you this disclaimer. For the avoidance of doubt, nothing in this webinar should be considered as investment advice. This is purely for educational purposes only. At Blockchain Co-Investors, the lessons of the internet serve as the foundation for our mission. In the dot-com boom, most startups failed. But if you had invested in Amazon or Google at the early stage, you saw some of the best returns of any asset class. It was incredibly important to be diversified and to invest with the top fund managers. So at Blockchain Co-Investors, we believe that this is the optimal strategy for investing in blockchain, to be early and to be highly diversified. That's why we offer our LPs a single, simple investment, which gives them global diversified exposure at the early stage. One check and you're invested in something like 400 early stage blockchain startups, many of which we're actually going to talk about today. We're now raising capital for our 7th fund, which we believe is positioned to be our top performing fund. For one, our first 4 fund of funds have a track record of top performance. Through those funds, we're investors in about 40 underlying early stage funds, and we think that that gives us an asymmetric information advantage, right? We have more information than many other fund investors in the space, but that would be meaningless without guaranteed access. So in venture investing, manager persistence is extremely high. Basically, what that means is that the top quartile fund managers, well, they tend to remain in the top quartile in the next fund. So we've gone out and secured side letters to guarantee access for us to continue investing into successive funds of top performers. And then finally, given the valuation environment and scarcity of capital, as interest rates have remained higher for longer, this is potentially the best investor climate in a decade. And early stage ventures traditionally outperformed periods like this, and we think now is no different. And so that's really the flywheel we've created. We won't spend a lot of time here, but we do think that it's proprietary. We have more information than anyone else, coming out of top performance, gone out and secured guaranteed access, which means that each new successive fund, we get to follow on into the best fund managers in the industry. Last page on Blockchain Co-Investors before getting into the meat of the presentation. We've been doing this for 10 years. As you see today, we do think our investment thesis is playing out, upgrade of the world's financial infrastructure. We've invested across 4 funds, backed more than 80 unicorns through those underlying funds that we backed, and now have assets of approximately 200 million. So what about blockchain's commercial application? Well, we'll actually start out and look at the internet and just do a brief review of how the internet developed. And as you'll see, the internet took about 30 years to reach commercialization. So the first 30 years are actually mainly development with not a lot of actual use cases. You can contrast that with blockchain technology, which has not only matured relatively quickly in under 2 decades, but also already has a breakout product and commercial applications. And that product is stablecoins, which have emerged as the killer product with multiple commercial use cases. But there are other use cases that we'll talk about today, including near-term and anticipated use cases, such as identity verification, storage, asset tokenization, and broader Web3 applications. But very importantly, stablecoins, as you'll see, are the first breakout demonstration of tokenization, which we believe, and many of the top financial firms in the world believe, underpins the next wave of financial innovation. So before getting into blockchain, we'll just do a brief history of the internet. Now, this is not all-encompassing, but just hitting the highlights. And this slide basically provides a brief overview of the major milestones in its evolution. So in the 1960s, ARPANET was created. This is where it all began, essentially. The US Department of Defense initiated what was then called the Advanced Research Projects Agency Network. later to be called ARPANET, which is the foundational project that would later give rise to the internet as we know it. Basically, scientists were able to utilize shared resources on computers in different locations, mainly researchers and universities in different parts of the United States. Then in the 1970s, TCP, or Transmission Control Protocol, and later the Internet Protocol were developed, and these protocols are essentially the backbone protocols of the internet that allow for the seamless transmission of data, equivalent data, across these networks. The 1980s is really start to see the foundations of the internet as we know it be laid, and that's when the World Wide Web comes into fruition. And this is essentially a global network of computers. And alongside this introduction, we see DNS, or the domain name system, basically website addresses, which make it easier to navigate the internet without actually having to know the individual IP destination or address. So really, in those 30 years, there's not a lot happening in the internet outside of research circles. But in the 1990s, this is when the internet becomes more accessible to the general public, thanks in large part to the release of browsers like Netscape Navigator. That comes out in 93, 94. We'll talk about that later. But basically, this era marks the transition of the internet from a primarily research-oriented tool to one fit for commercial and personal use. Then in the early 2000s, we actually get new business models emerging on the internet that were not previously possible in the analog era. That's the rise of social media platforms like Facebook, Twitter, and YouTube. This transforms how we communicate, share, consume content, of course. By the 2010s, smartphones are ubiquitous, and the internet basically has a revolution in cloud computing and storage, right? So we see a shift away from local storage to cloud-based solutions, which makes data using these services much more accessible, much higher bandwidths. And that leads us to where we are today. Today's internet is dominated by technology giants. We have over 5 billion global users and a 60% penetration rate worldwide. But the fascinating thing, I think, is if you look at this again, very high level summary, but just that there wasn't really any commercial use case in the first 30 years, right? So most ordinary people, they didn't know what was going on in the background, as essentially the early computer scientists were building the core infrastructure. To put it another way, sure, some scientists in UCLA could send a message to other scientists at NYU or MIT, but there wasn't a broadly available commercial product. And that really changes in 94 when Netscape launches. Now the average person can surf the internet, and this is when we believe the internet really starts to commercialize. So after this, nearly every company needs to have a website. The users of the internet just grows exponentially, as you'll see, and it really starts that cascading effect, really the Cambrian explosion of new products of what we see today with the modern internet. And this is where we stand today. So you can see this chart here, 60 years on from development of the internet, 30 years on from kind of that Netscape Navigator moment. We have about 60% global internet penetration. You can see the blue line there representing the world. North America, we're closer to 95%. Europe, in excess of 85%. But it took 60 years, right? So there's a lot of takeaways from this chart. And one is, wow, that's been really fast. In 30 years of a Netscape Navigator, or 60 years from really the development, we have 60% of the world using it. On the other hand, we still have 40% to go. So a lot of value, a lot of people around the globe still haven't used the internet. And the data here is users who have used the internet anytime in the last 3 months. So still a lot of people to kind of go fully online. And still remarkably fast. But now we can draw your attention and kind of contrast that, or really see the similarities, with the meteoric rise of blockchain technology over less than 2 decades, right? So the blockchain era really begins in 2008 with the introduction of the Bitcoin white paper, which was titled A Peer-to-Peer Electronic Cash System. And Bitcoin was really a revolutionary idea. Computer scientists had been trying to crack the code of a decentralized money based on the internet for, really since the 90s. But this is when it really works for the first time. And in short, we have our first decentralized digital currency where transactions are secure, transparent, and immutable. And starts the trend that we now refer to as cryptocurrencies. Bitcoin launches in 2009, and there are some other notable projects that launch after that, experiments. But really, the next major development, if we're sticking to the highlights, is in 2013 with the Ethereum white paper. And more than just a cryptocurrency, Ethereum allows developers and allowed developers to create customized code and decentralized applications on top of a decentralized network of computers. So Ethereum has on top of it what's called a Turing complete computer, where any arbitrary code can be executed on top of it. This really opens up the door to using blockchains for many, many other use cases besides money, right? Bitcoin is just seeking to be electronic cash, a form of money, form of store of value. And after Ethereum, or Ethereum is really the famous one, really this opens up the idea that, wow, blockchains can be used for so much more. This is why Ethereum is often called, or mainly used to be called, the world computer. And then fast forward just 10 years, again, so about 15 years on to 2023, you have nearly 2 million different tokens launched, a market cap of about 1.52 billion now, 500 million users worldwide. So again, in just 15 years, essentially blockchain has already hit breakout adoption with hundreds of millions of users. Again, not quite at internet scale. It's using the tracks laid by the internet, but it really does put it in perspective that blockchains and cryptocurrencies have become, a very large industry in a very short amount of time, a very kind of rapid rise to $1 trillion industry. And why are people using it? What about the applications or use cases of blockchain technology? So this is a bit of a mental model for us and how we think about the applications and the current, near-term, anticipated. And really to start, for me, the simplest way to describe blockchain's potential use is that they allow for peer-to-peer coordination across the internet. So blockchains are really good at coordinating what would otherwise be these distrusting parties to do something in the digital verse, right? And so you can think of Bitcoin as we're trying to exchange value. Two people don't know each other, and we want to make sure that that value exchange is legitimate and everyone says they're going to do what they do. That's really a coordination problem. So Bitcoin starts that with cash, with payments. And that really is the first real world use case of blockchains right from the start, right? So that's that upper left right there. Bitcoin offers a secure and swift method for peer-to-peer transactions. It's still the simplest and most salient use case today, in my opinion, but has really been usurped by stablecoins, as we'll talk about. But really, payments is prime use case and a current use case, as you'll see, of blockchain technology. A close second, we would argue, is blockchain's application as a store of value. So whether through access to cryptocurrencies like a Bitcoin or an Ethereum, or directly to dollars via stablecoins, again, we'll come back to that point, blockchains allow for basically anyone with an internet connection to have access to global stores of value that they previously did not have unless they were well connected or some sort of international access to the financial system. So that's very important. We'll come back to that. Another use case today that's working in a multi-billion-dollar industry is DeFi, or decentralized finance. So DeFi, this is a catch-all phrase for basically a financial system built on top of blockchains like Ethereum, like these smart contract, world computer style blockchains. Basically, you can think of any financial product that could be built in the traditional financial system that utilizes a central intermediary like a bank can be rebuilt only using code into a smart contract blockchain. So you can do things like, trading without any sort of middleman or order book. You can create loan markets via money markets in the same fashion, derivatives, any other financial product, and even new financial products that were not previously considered, such as perpetual futures, which exist in cryptocurrencies, which don't exist in the traditional financial system, are able to be created on these decentralized networks. It's really an exciting area and already a $50 billion, $75 billion plus market, and very interesting. The last one, and again, this is not all encompassing, but the last notable one that we would say exists today is art and collectibles. And in 2021, we saw the rise of NFTs. You may have heard of these, are non-fungible tokens, which are basically tokens that are unique, right? They're one of one. And so you can tie a token to some sort of asset, some sort of digital asset. And since then, we saw a revolution in digital art and collectibles. And this has led many global brands to enter the NFT arena, right? So every large brand you've heard of, from Adidas to Nike to Dolce and Gabbana, all of them have NFT strategies and have engaged with this space because it is really the emerging frontier in brand management. In terms of near-term applications, and we see this because we're investing into the funds and projects that are building these, there are several exciting things more or less around the corner. First and foremost, we have asset tokenization. So this is the process of representing an asset on a blockchain. We're going to come back to this, but this has massive implications for upgrading the world's financial infrastructure, and many of the world's leading financial institutions are very focused on this. Identity is a very large theme. So particularly with the rise of AI, you've seen AI's ability to generate sophisticated bots that could even mimic, individual people. And so blockchains are being used to verify humanness across the internet. One notable project is WorldCoin. We're invested via one of our fund of fund funds, and WorldCoin is started by Sam Altman, the same founder as OpenAI. And basically what they do is they issue you a unique token that you can only have to verify your humanness, that proves that you're not a bot. Again, not yet fully functional, but something we see around the corner, something that we definitely see blockchains as being used for. Gaming. Many blockchain-based games are in development. There's been a few actually released that did have some uptick, but they are very rudimentary. So I wouldn't say that this is really a current use case. We have invested in some, AAA games that will be as good as your Call of Duties, your Halos. Those have not yet come out. We're excited to see those, but it does take many years to develop top quality games. And then finally, compute. Particularly with the rise of large language models and the amount of compute that these models need to train their data, there are several projects spinning up that are blockchain-based, such as Definity or Jensen, which are backed by top investors, many of which are in our fund of funds as well. And basically what these do is they solve a coordination problem of compute resources. So decentralized networks of computing resources, very exciting. And then finally, last but not least, what we label as anticipated are the broadly, referred to Web3 applications. And we won't spend a lot of time here, but you can think of Web3 most broadly as an internet that is user and creator owned networks. So you can think of it as if, imagine that with Uber, right? The early adopters of Uber, the early drivers, they really built the value of the network. Uber is not worth very much if there's no one driving around. But those early adopters did not share in the governance, the value accrual, or anything of the Uber network, right? And so you can imagine now with blockchain technology and tokenization, the ability to create sort of internet protocols, internet companies, whereby the actual contributors to the network, the influencers on a social media platform, the writers on a newsletter platform, etc., actually would receive tokens for participating in the network. And these tokens would carry some sort of governance or value accrual rights. Again, this is very further off in the distance. There's a lot of excitement about this, but this is not, something we believe that's being used for today in terms of commercial application. But what about commercial products? Where is blockchain's, Netscape Navigator moment that we saw in 1994, where we had this Cambrian explosion of internet usage? There's Mark Andreessen there, a big blockchain investor today via his firm Andreessen Horowitz. A big backer of many of the themes that we're talking about. And he was the co-founder of Netscape Navigator, which went public in 94, 95. And I would argue, and I think many in the space argue, we're in the midst of it right now, that we already have our first killer product. And that killer product is stablecoins. And stablecoins are a very innovative product, commercial product, generating revenue, generating profit, large amounts of profit with multiple use cases. And a stablecoin is basically a cryptocurrency that's designed to have a stable value, almost always by being pegged to an underlying asset, which is almost always, as you'll see, the US dollar. And as you probably know, cryptocurrencies like Bitcoin and Ethereum do experience high degrees of volatility relative to assets like the dollar and the euro. And stable coins are basically designed to have the same functionality as a Bitcoin or Ethereum, right? So the same attributes as those cryptocurrencies, meaning that they travel on a blockchain, they're immutable, instantaneous settlement, cheap, all the attributes of a token on a blockchain, but giving you the value and the sort of stability of an asset like the US dollar. And there are three types of stablecoins. There are fiat collateralized, which are basically where an issuer holds the same currency in reserve. So a dollar-backed stablecoin would have an equivalent amount of dollars in a bank account somewhere. There's crypto collateralized, where a dollar-backed stablecoin would have Bitcoin and Ethereum in a reserve somewhere. And then there are algorithmic stablecoins, which try to create a synthetic peg by not holding anything in collateral, but may do something like go long and short the same asset to create a synthetic peg. And today we're going to focus on it, and we think it's very important for kind of new people to the space to maintain their focus on fiat collateralized stablecoins. And this is because these are the battle-tested stablecoins. This is where all the value in stablecoins have gone. And these are the only stablecoins we've seen that have not, at least the large ones, have not broken the peg and sort of crumbled. In the other two baskets, you have seen those stablecoins come off the one-to-one peg and lose value relative to the dollar. And it's really simple why that would be the case for fiat collateralized stablecoins. And you can see the mechanics here. This is kind of a simplified version of how these stablecoins would work. But basically, you would have a user. This user would give, let's say, $100 to an issuer like Circle. Circle manages the most famous US-based stablecoin, USD coin. And Circle would then give you 100 tokens called USDC. And those tokens, you would hope, would have the value of, $100. And what Circle does with your $100 is it takes that $100 and it goes and puts it into a collateral basket. You can see on the right there, labeled by B. And what Circle does is they put it into US Treasuries, money markets, and AAA rated corporate debt and earns a bit of a yield on that. That's their business model. And the peg is basically maintained because at any time a user can go and redeem from Circle the equivalent value of their coin from the collateral basket. Meaning that if the peg were to fall from 1 to, let's say, 90 cents that the token was trading at, an arbiter could come by the token for 90 cents and redeem it for $1, netting a 10-cent profit at any time. And this mechanism has maintained the peg for Circle. It came off the peg very briefly during the U.S. Middle market banking crisis last year, but quickly regained the peg, and Circle was able to, fall through in all of its redemption. So it's a very, very solid system that we've seen battle tested. And because of this, these types of stablecoins have accumulated a massive amount of supply, right? So now we're talking about nearly $200 billion in stablecoin supply in a very short amount of time. So become an absolutely astronomical market. We're going to have a few charts on this that will show you just how big this is in such a short amount of time. Many people don't know, but really stablecoins are the most popular cryptocurrency by use by a wide margin. So the most used cryptocurrencies are not Bitcoin and Ethereum. Those have high values. Those are mainly just held. The most used cryptocurrencies are stablecoins. And you can see, again, USDT, which is Tether. That stablecoin is the largest stablecoin. It's based outside of the US, but is, I believe, the 20th largest purchaser of US Treasuries. And stablecoins as a whole are the 16th largest purchaser of US Treasuries in the world. So already having a massive impact on the Treasury market. And it's very dispersed, so it's not just whales. So you can see the statistic there that 25 million different blockchain addresses have at least $1 in stablecoins. That would make stablecoins the 5th largest US bank by number of accounts. So again, already getting into kind of banking level numbers in terms of account ownership. So very, very interesting. And again, all operating on top of public, permissionless, decentralized blockchains for the most part. And in terms of a payment channel, stablecoins are seeing lots and lots of flows. So you can see in 2022, this lists stablecoins versus some sort of major payment channels. Stablecoins as a whole settled $11 trillion on chain. That dwarfs the volumes that you see in PayPal, about $1.5 trillion, and is right up there next to Visa. And there are over 1 billion stablecoin transactions, so not quite as many as PayPal or Visa. Visa has, 190 billion, so still way ahead in number of transactions, but is already settling, almost equivalent value as Visa. And you can see over time that this is really trending upward. So really since 2016, when this launches, when these start, experiments start to launch, you see that it's already overtaken the remittance networks. It's already overtaken PayPal, and it's right there next to Visa. And you can see head-to-head versus Visa. We'll get some new data in the coming months, but a lot of people think that stablecoins will pass Visa this year in terms of dollar value actually being settled and moved around. So very, very interesting. Already a very big part of the payments network, as you can see, in a very short amount of time, basically 4 years since it's been really out there in the open. And the largest payments companies are taking note. So we'll see that in a few pages, but it's not just people in the crypto and blockchain industry who think that this is a big deal. It is, leading payments companies. And the last thing to show before moving on to the next section is just that it's been very sticky in terms of the users and sort of an upward trend. So while the volume and value can shift based on kind of market dynamics, if you look at unique active addresses that are engaging with stablecoins, this has been a constant trend line upward, despite the sort of market correction you saw over the last year, though we've come back from it. We had very sticky adoption in stablecoins. And so payments companies basically want in on the party, right? So PayPal, again, a traditional innovator in the payments industry, they've actually now launched their own stablecoin, right? So they are the kind of most prominent financial institution in the world to do this. We suspect many others will do this. We suspect if we get stablecoin legislation in the US, many banks will do this because it's simply a superior product, instantaneous settlement, cuts out so much back office staff, cuts out the US banking system, which has exorbitant fees. It really just makes sense. So PayPal has launched very recently, but it is live and you can use it. PYUSD is the ticker, PayPal USD, in conjunction with Paxos, which is a notable issuer as well. And we're working with companies who are integrating the stablecoin. So while it's not yet a big player, the PayPal stablecoin, PayPal is obviously making a push into this space because they see some of the payments flows are subverting them. And then Visa, very interestingly, also just recently in Q4 of last year, while they didn't announce their own stablecoin, they announced that they would actually start to allow merchants to settle on the back end using USDC. So again, the Circle stablecoin, the one we talked about, with its merchants. And this makes total sense for Visa because you can imagine Visa, right? If there's a transaction in London, for 10 quid, 10 pounds, they have that point of sale with the customer, and they need to somehow get the 10 pounds less their fee to the merchant. So right now what Visa does is it uses its networks of banks to send international wires, which creates lots of fees and can take multiple weeks to ultimately settle with that merchant. Well, now they're going to start settling directly with stablecoins instantaneously with merchants. So again, it makes total sense. We'll reduce their fee load massively and reduce the reliance on the banking system for the back end. So you can see that, again, two of the largest, most important payments companies in the world, they see what's going on. They're leaning into this. And so why are people so involved? Why is it taken off so much? Why are stablecoins being used so much? Well, they really touch on 3, if not 4 use cases. And again, the first is for payments, which we talked about, so won't cover that anymore. The next is store of value. So you've seen a huge amount of stablecoin usage particularly in developing countries where there's a scarcity of dollars, but there's insatiable demand for dollars. So in places like Nigeria, other parts of Africa, Argentina, Venezuela, Asia, you have many countries with historic currencies that have lost their value, had high rates of inflation. And so when you give people on the ground, anyone with an internet connection, now 60% of the globe, the ability to sign on and convert their local currency into a synthetic dollar, which is basically what a stablecoin is, right? It's a token representing a dollar. It's a lien on a dollar in an account somewhere. You can see that the demand is just crazy, right? Because international trade is settled in dollars, people want to save in dollars. And so that is a huge part of the story as well. It's just an insatiable global demand for dollars for that store of value. Within DeFi, in sort of crypto economic networks, you also see stablecoin as a really important collateral asset. So whether or not you're providing liquidity for trading pairs or taking out a loan or supplying the loan, normally you're going to have a stable coin as one of the pairs in that transaction. And then finally, we'll talk about it much more in the rest of the presentation, but it really is the first breakout example of asset tokenization. And to go a bit more into depth into asset tokenization, this is core and central to the blockchain co-investors investment thesis. We believe that blockchain technology is going to do to commerce what the internet did to communication and content. So we're going to digitalize finance, we're going to make it programmable, we're going to upgrade the world's financial infrastructure, and tokenization is a very large part of that. Because tokenization is basically taking an asset and representing it as a token on a blockchain, kind of in its simplest expression. And so you can see stablecoins is basically taking a dollar and representing it as a token on a blockchain, a USDC, USDT, PYUSD. Those are all tokenized representations of dollars. Basically, they're equivalent to dollars if you trust the blockchain network. There are other ways to do digital money, such as Bitcoin. Bitcoin's a digital money, but stablecoins are a tokenized version of dollars or euros or pounds. But you have other expressions of that. You have digital commodities that you could represent. You have digital assets you could represent, financial assets. We'll get into that. But really today, the breakout use case are those digital dollars, are those stablecoins. Before moving on to tokenization, what does this actually look like on the ground? How can you actually invest in this? Well, just to call out, we've invested about a year and a half ago in a company called Yellow Card, and we were recently reinvested into their new round. And Yellow Card is a financial infrastructure provider across Africa, one of the licensed Pan-African digital asset exchanges operating in more than 20 countries. And really what they do, if you think about it most simply, they're giving SMEs and high net worths and individual people across Africa access to stablecoins to do everyday business. So their sort of prototypical customer is a Nigerian SME that engages in import and export, right? So they're buying goods from overseas, they're selling goods overseas, or they're selling goods domestically. And something like 85% of all trade is invoiced and needs to be settled in US dollars, even if the two countries involved are based in the US. And so you have a system in Nigeria where many of these SMEs simply can't get dollars. And so they can approach a company like Yellow Card and they can settle this transaction now in stablecoins, instantaneously, cheaply, access to dollars. So Yellow Card is doing extremely well. We're very excited about this. They're growing very fast. They have real customers. And, just to show you that the types of investments that we're making, if you're in our fund to fund, you have exposure through, I think, 4 or 5 of the underlying funds. And if you're in the mid-stage growth fund, you're invested in this directly as one of the largest investments in that fund. So now back to asset tokenization. What exactly does that mean? What are the trends? Well, so aside from money, so stable coins, according to BCG, they think that we're going to have a $16 trillion global liquid asset market for tokenization by the end of this decade, which will include things like listed equity, unlisted equity, investment funds, bonds, home equity, and really all sorts of financial assets will tap new forms of liquidity and tap into those cost savings in terms of compliance, settlement, backend. And this is not just something that BCG is putting out. Very notably, Larry Fink of BlackRock is very prominent in stating his support for this. You can see his quote here: "If we can create more tokenization of assets and securities, and that's what Bitcoin is, it could revolutionize finance. I believe the underlying technology is fantastic. We don't need custodians anymore. It's an advancement of technology." And you've seen him time and time again. I encourage you to go look at some of his Fox Business interviews, but he's basically repositioning BlackRock to take advantage of this wave of tokenization. He sees it as the next frontier of financial innovation. Again, this coming from the man in the firm that were really the first firm to embrace ETFs in a large way, which is now the most successful financial product of the last 25 years. BlackRock is the largest firm in the world by assets, the most important firm in Wall Street. So it's not just blockchain enthusiasts, crypto native people who believe blockchain has a application here. You have Larry Fink essentially agreeing with the blockchain co-investors thesis that blockchain is going to upgrade the world's financial infrastructure. And he's more than just saying it. So many of you probably didn't see, but just last month, BlackRock very publicly tokenized a fund with Securitize. And so the BlackRock, this is its first tokenized fund. So it's called Buildle, and it's launched on the Ethereum network. Again, a permissionless, decentralized, open source protocol, Ethereum, that you can put any arbitrary code on. They've created a token that gives you a lien on the BlackRock USD Institutional Digital Liquidity Fund. And what that fund basically does is invest into US Treasuries. So essentially, it's very similar to a stable coin, right? They're offering a stable value of $1 per token, but it's more than a tokenized stablecoin because it's actually a tokenized money market because they're going to pay you accrued dividends based on that yield. So they're actually going to pass that yield on to you. So this is different than a stablecoin because you're not actually stablecoin, you're just holding $1, like as if you were holding $1 of cash, right? You're not earning yield on that cash. But a stablecoin is not a security, whereas a money market is a security. So this is only available for accredited investors, whereas stablecoins are more widely available. But again, very, very interesting, been very successful so far, $40 million in the first few weeks of debut. So very successful tokenized fund from one of the most famous, if not the most famous financial firm in the world. And then on top of that, they also announced a strategic investment in Securitize. And, full disclaimer, Blockchain Coinvestors is invested in Securitize. So this is a portfolio company of ours. So we're very excited about this. But again, just goes to show that asset tokenization, whether stable coins or other sorts of assets. I mean, we're seeing this today in terms of payments, stable coins, multi-hundred-billion-dollar industry, PayPal, Visa coming into it, other tokenized assets. We've seen many, many different managers, and now most notably the world's largest manager, BlackRock, come into the space in a very public way, partnering with one of our portfolio companies. So to sum up what we covered today, again, I hope we put that in perspective that the internet had 30 years of development before any sort of wide-scale product was used by millions of people. And if you contrast that, we've had 15 years of blockchain development, and it's matured substantially and introduced notable commercial applications, including a sort of killer app, a killer standout product. So on top of this is really demonstrating the power of tokenization and shows you what's around the corner and how some of the leading financial firms are positioning themselves, because the benefits of tokenizing money are very easy to be felt in things like payments, store value, DeFi, but tokenizing other assets will also bring those benefits. And so it really does underpin the next wave of financial innovation. We're very excited about it. I hope this made sense, and very excited to see what else BlackRock does in the space with our portfolio company, Securitize. For those of you wondering how to get exposure to tokenization, to stable coins, again, the way we set up the fund is we thought it's very difficult to pick winners in such a high risk, high return asset class, but we know that the innovation is going to happen somewhere. And so we wanted to create a very simple vehicle, one investment where you invest in something like 20 underlying fund managers, which will give you exposure to something like 400 projects and startups, many of them tokenized, tokenization firms like Securitize, like Archax based in the UK, like Circle, like Tether. So we set up Blockchain Coinvestors to do that. So if you're interested in hearing about those funds, or you're interested in learning more about tokenization or stablecoins, please reach out to us at ir@blockchaincoinvestors.com. Thank you so much for listening. We really do appreciate your time.